Hello, in this presentation we will define the break-even point. According to Fundamental Accounting Principles, Wild 22nd edition, the definition of break-even point is output level at which sales equals fixed costs plus variable costs, where income equals zero. An example of the break-even point, or the calculation of the break-even point, would be the break-even point in terms of units. Make sure that we recognize we're talking about units here. Would be the fixed costs divided by the contribution margin. If we were to consider the break-even point in terms of dollars, we would then take the fixed costs divided by the contribution margin ratio. Let's take a look at an example. If this is our data, and we're going to calculate the break-even point in units, we have a sales price of $310, fixed costs $421,600, mixed maximum capacity 550,000, and variable cost of 186. We're going to first look at that contribution margin per unit, that being the first calculation needed. We're going to take the sales price per unit minus the variable cost per unit. That will then give us the contribution margin per unit. So the 124 will be the denominator of our calculation for the break-even point in units. The contribution margin percentage then would be 40%, calculated as the 124 divided by the 310. We then take that number and we're going to plug that into our formula, taking first the fixed costs. So we're going to take the 421,600 total fixed costs, and we're going to divide that by the contribution margin per unit that we just calculated in order to get to the break-even point in units. Therefore, what this means is that we would need to produce 3,400 units in order to break even. Very useful number to have, the break-even point in units. Also very useful to use a similar calculation to tack on estimated profits as well. We may be asked, however, also not just the break-even point in units, but the dollar amount, the sales amount of the break-even point, which can be calculated a few different ways. If we take our calculation up here and we calculate the break-even point in sales dollars, we could just start with the fixed costs, as we did last time, 421,600, and divide by not just the contribution margin, but the contribution margin ratio, which remember was the 40%, that being calculated as the contribution margin per unit, 124 divided by the sales per unit, 310. Therefore, we have a contribution margin of 40%. So the fixed cost divided by the contribution margin would give us the break-even point in terms of dollars. In this case, 1,054,000. This is really the formula you want to know and memorize, but we can also think of it after calculating the prior break-even point, that we could take the break-even point in terms of units. That's how many units we need to produce in order to break even, and multiply that times the sales price, and that would also give us that same 1,054,000, the break-even point in terms of sales dollars. The reason you really want to know that prior calculation is because in book problems, this data may not always be given, and you may have to work the problem in kind of strange order, in which case you would need to know the prior calculation in order to work many of those types of problems. In practice, this may be a useful way to think about it as well.